Investing propaganda that drives me insane. First of all, happy Father's Day to all you legends. I drank a little bit of caffeine this morning, so I got a little bit of a caffeine rush. I'm gonna hit the gym. It's 8:50. I got to do some bench, some shoulders. So I'm on my way to the gym. Then we're gonna go to a Gwinnett Stripers minor league baseball game, AAA for the Atlanta Braves. My wife's going to make me a vanilla cake with vanilla frosting because chocolate cake with vanilla frosting is only for communists, all right? And because I'm not a commie, I like vanilla cake with vanilla frosting. I eat some bacon, eggs, and some hash browns for breakfast. It's basically a legendary day. I come back from the baseball game, take a nap. It's going to be good. I'm not sure what we're doing for dinner. Tomorrow I'm going to do smoke some ribs, and we're gonna have those on for a long time. But anyway, so I just read this thing on LinkedIn. Some guy posted about some pension fund that has beaten the S&P 500 for 1, 3, 5, 10, 15, 20. At first, I don't believe that for 2 seconds flat. All the way for 50 years, all right? And the guy's like, this is what you do, and blah, blah, blah. I was like, but then it goes on to say, it beat the S&P 500 for the equity portion of his pension fund. And he didn't say that until you had to dive deep in there. And look, I don't really care, to be honest with you. Just tag the freaking index and be fine. First of all, I don't believe for 2 seconds flat that a fund has beaten the S&P 500 in every time frame. That doesn't make any sense at all. I'm sorry, it just doesn't. Even if you're value, because this guy was heavily value, there's just no way. But I'm not going to dive in it because I just don't care that much. But it drives me batty when people post this stuff because they're trying to do it as a way to say, you can also beat the S&P 500 with this strategy. And I'm just like, stop. Just, there will always be somebody who beats the index. The question is somebody going to be consistent? The answer is no. You just can't beat the index consistently. You just can't. Value stocks underperformed for the last 15 years. If you're heavy on value, you underperformed. If you're heavy on value in the 70s and 80s, you outperformed. But I'm just, it drives me crazy. And then if you're going to compare yourself to S&P 500, while you also have exposure to small caps, and I don't think this guy was talking international, it's just a stupid thing. And then because that's the one way to justify your fees, all right? Because you're saying, I can beat the S&P 500. I'm not saying I will, but I said I can because we have people who have done that. And I don't follow Warren Buffett stuff that much anymore. I mean, I used to back in the old days, back in, late 90s, early 2000s, read his annual report because I fell for the freaking stuff. And I just, Warren Buffett's a clown. I mean, just my goodness. But there's always going to be a winner, all right? The facts are there'll always be. This is just the odds, just basic math. You have the average. And then you have people who are above average and people who are below average. The question is, are the people who are above average, will they be above average tomorrow, the next year, the next year? And you don't know. You don't. In fact, history shows us that 75 to 80% of the investment managers out there underperform the index. Why? Because of fees. Now, I talked about this in my investment course, by the way. And again, I have a coupon on there. It's down low. The number 50. If you want to buy my investment course, it's you get 50% off. Just use the number 50. It's the links in the show notes. And I talk about this. I say, so if the average, I look at like an NFL team, all right, the NFL team. Every single NFL team, and this one they used to have 16 games as opposed to stupid 17. On the average, the NFL team went 8-8. Some went 12-4, some went 4-12 and whatnot. But when you factor in fees, the average NFL team went 7-9 when you factor in fees. I mean, that's just the way it is. So the S&P 500 goes 8%. Yeah. So the average portfolio went 8%. That's 1% right. But the fees on the average portfolio make it most funds are going to underperform the S&P 500 because of the fees. The S&P 500, there are no direct fees. So if the S&P 500 is 8%, that's the average. We'll just use that for an example. And then you got to factor in your fees, net of fees. The average portfolio is 7% inherently. Are a couple going to do better than the 8% net of fees? Yes, unequivocally. That will have to happen. There'll always be funds that do better than average. That's a fact. But at the end of the day, net of fees, which is what matters because you are the one paying the fee, the average portfolio underperforms the S&P 500. It will continue to do so consistently, religiously, without fail. It will be impossible for the average portfolio to beat the S&P 500 unless you had a massive calamity of... I mean, averages can be skewed in one way. A massive calamity where all these, a significant portion of investment managers basically got zero returns essentially. Everybody else, and I don't even know what the numbers would be to make that happen. But yeah, it will always be the average money manager will underperform the S&P 500 net of fees, and net of fees is all that matters. There's just no two ways around it. It's just basic math. And then the funny thing is to say, and this would actually kind of tick me off. And again, I didn't do the research on this. I don't know. But I don't buy for 2 seconds flat that this fund manager was able to outperform each and every time frame, 1, 3, 5, 10, 15, 20, and 30. I don't buy that for 2 seconds. Especially, I don't buy it for 2 seconds if the guy's saying, and he's a passive investor, this pension fund, i.e., they just buy the funds and hang tight. They don't trade or they don't active manage. I don't buy that because again, growth has done one thing over the course of 10 years in 1990s. Value did another thing over the course of 10 years in the aughts, and I don't buy it. And we just don't fall for this propaganda, dude. Be content with your market returns in the S&P 500, even better VTI, which is the total stock index. Oh, by the way, when you factor in the bonds, though, you did beat the S&P 500. That's another thing that ticked me off. Oh, when you factor in the equities, when it's just the equity portion of his portfolio beat the S&P 500, all right, but that's not the entire portfolio. That'd be like saying the Wellington Fund's equity portion beat the S&P 500. You're like, yeah, but the Wellington bad bonds in 2022, those bonds were a freaking albatross around the neck. Way too much ink is spilled on trying to justify fees. There's just no other way around it. Don't waste your time. Certainly don't waste your money. I mean, my goodness, man. The evidence is so overwhelming now. It doesn't make any sense. Like, if you want to buy, the simplest way to beat the market is to be concentrated. That's all there is to it. If you think the tech stocks are going to bang it out for another 10 years, and you're right, you could be right. You could be wrong. It's very aggressive, and if you beat the market, it's because your concentrated portfolio did better than a market-based diversified portfolio. That's great. That's a risk, though, because you could have also bought, I don't know, freaking energy stocks and whatever, the odds. I don't know what the energy stocks got crushed, not in the 70s, 80s, I can't remember. And you say, ooh, I took a gamble. My gamble either won or lost. Either way, it's still speculative. And we don't want you to speculate with your portfolio. We want you to invest. Invest means sit pretty, sit idle, sit for the long term, lower your fees. Don't make freaking drastic changes anytime. Just sit there, have some cash on the side, and you're going to be G2G. That is good to go. All right, God bless. Enjoy your Father's Day. Remember, Dad's crush. Dad should always and everywhere be is respected as long as they're doing dad stuff. If they're being scumbags, they shouldn't be. But we need more masculinity, not less, which means more fathers need to contribute. All right, God bless.